past 2 years has been a challenging period for real estate valuations. A rapid rise in rates has led to a rebasing of real estate income yields, ensuring they're sufficiently above the higher borrowing cost. This increase in market property yields since mid-2022 has resulted in the largest reduction in values recorded since the global financial crisis. Over this period, market valuations have decreased between 8 to 21% across the major sectors. The chart on the screen illustrates the growth in unlisted real estate capital values since 2000. As this shows, all sector downturns are relatively infrequent. Usually, sectors grow at varied rates, at times negative, based on respective circumstances. This typically results from structural changes in demand or an imbalance in supply. However, on certain occasions, an external force will inflict a broad-based negative impact across all sectors. When this occurs, they're highly concentrated. Over the past 100 quarters, 82 recorded value growth across the all sector average. Since then, values have increased by a compounded annual growth rate of 4.5%. The previous two expansionary periods extended for 43 quarters on average. Outside these periods, 3 downturns represented 18 quarters of negative growth. The global financial crisis in 2008 was the largest decline we've seen in property values before the current downturn, lasting 8 quarters. As we move into the 9th quarter of the current downturn, there are a few signs to suggest that we're approaching an inflection point in real estate values. This chart is based on a real-time sentiment survey produced by external valuers and agents. Portfolio values typically lag this indicator by 1 to 2 quarters, given the additional requirements of undertaking a formalized valuation process. As this chart shows, the all-sector average values, represented by the black bar, appear to be stabilizing. The adjustment in income yields have slowed, and strong rental growth is taking a greater precedence over valuation outcomes. The improvement in conditions have been led by the growth in the industrial and logistics sector, highlighted in yellow, and the stabilization in retail values, highlighted in red. Office values, highlighted in blue, have continued to adjust. Other factors suggest real estate values are bottoming out. As inflation continues to come down, expectations on Reserve Bank policy and interest rates continue to decline. This should support the cost and availability of debt. Economic demand should also improve with reducing rates. High-quality real estate continues to benefit from low levels of vacancy and solid demand. This creates a great foundation for recovery. However, as we move into this next phase, we believe performances will be more diverged. Assets with strong rental growth and cash flow resilience will lead the recovery. By contrast, secondary-grade assets with high functional obsolescence will be challenged by high levels of vacancy, softer demand, and elevated construction costs. We hope you've enjoyed this market update. Please reach out to the Charter Hall team if you have any more questions. Thank you.